So the United States has had a long history of regulation and supervision of financial institutions and bank holding companies. A lot of that history has really been what we now call microprudential supervision. We look at institutions one at a time, ensure they're well capitalized, have sufficient liquidity, or have the sufficient controls in place to manage their business and so forth. But policymakers don't have an inherent interest in banks. It really is the impact the banks have on the real economy that makes banks special. So policymakers also care about financial stability and the financial system as a whole. And that has never been shown more intensely than in the recent financial crisis. So now the new focus, although it's been around for a while, macroprudential supervision, looking at banks in the context of the economy in which they operate, has been a real focus of the change in the Federal Reserve and supervision in general over the last 5 years. That's what a lot of this talk will be about. So the recent financial crisis has led to some historic changes in the regulatory and supervisory infrastructure for bank holding companies. The U.S. supervising and regulatory response, a lot of that is encapsulated in the capital plans rule. The international regulatory community response is seen most evident in the Basel III requirements. And the U.S. congressional response has been seen in the Wall Street Reform and Consumer Protection Act, also known as the Dodd-Frank Act. So that's the outline of the talk today. Now, when you think about the recent changes in the U.S. regulatory environment, you have to place this in the context of lessons learned from the crisis. And there are sort of some of the long-standing economic assumptions didn't hold in practice over this period. Bank holding companies didn't always maintain robust controls. And here, there's an outstanding question. For a company, let's say, has a 1 or 2 or even larger trillion-dollar balance sheet, is that failure in the internal risk controls a failure in incentives or a failure in capabilities? So is it the case that there was a misalignment of internal incentives, and if we get that right, we won't have the type of bank failures and problems we had? Or is it really a $2 trillion institution with offices in dozens or scores of countries around the world? It's just too hard of a task for, let's say, a 20-person board of directors to have guarantee internal controls in that type of structure. So the answer to that question, of course, will inform what is the proper regulatory response to the crisis. And that, as I said, that's an outstanding question that may lead to additional research and additional, certainly, Federal Reserve response in the future. Market forces always didn't limit risk-taking activities appropriately. That's not a failure unique to the banking sector. If you take a look at a lot of industries over time, let's say the telecommunication industries in the late 90s, but the effects of a bank failure are particularly acute due to the externalities of the banking sector on the real economy. And we'll talk about that as well. The measures of current financial health are not always sufficient to understand the financial health of an institution. A lot of regulatory triggers were triggered off of the current capital ratios at firms. One of the outcomes of the crisis is that we do care about the current capital ratios, but we then put the institutions through stress tests and look at the post-stress test capital ratios to better inform us about the resiliency of the institutions. And also, the evaluation of individual firms is not always sufficient to inform us about the health of the institutions. We have to put that in the context of the health of the financial sector in general. And as we know now, there was a lot of leverage building outside the banks, so that the leverage ratios at the banks look to be in fairly normal historical norms and ranges, but the buildup of leverage in the household sector, buildup of leverage in the public sector, buildup of leverage in the shadow banking sector, the non-regulated banking sector, things like money market mutual funds and other things outside the banking sector, really made the whole system much more fragile than if you just looked at the banking sector itself, which seemed by standard ratios to be quite healthy. So what did the regulatory and supervisory approaches, how did they change, how did they respond? So now there's much greater focus on bank holding companies' longer-term strategies, not just their short-term quarter-to-quarter tactics. There's greater employment of cross-firm analyses. That's always been part of supervision, but it really has taken an enhanced role post-crisis. There's a greater focus on independent assessments of the firm's health in the context of the health of the entire financial sector. So frequently analyses would begin with the individual bank and its ratios and then ask what's the environment. Now we start with what's the environment in general and then put the analysis of the individual bank within the context of the economy. We look at the evaluation on a forward-looking basis as opposed to looking at current ratios. We shock the ratios and look at the ratios post-shock. And in general, this is what we're talking about when we talk about a macroprudential perspective, not just individual firms, but individual firms within the broader context. So for macroprudential supervision, we really have to start with why do we supervise and regulate banks in the first place? Banks are special. You need to sort of buy into that to understand why we regulate in the first place. So market failures are inherent in the banking sector. There is a structural fragility in the banking sector. Long-dated, risky assets, generally illiquid assets, are funded by short-dated liquid liabilities that pay off at par. That makes the banks prone to and susceptible to runs and panics. So that's just a basic fact about banks, and that is their business model, and it is a fragile business model. That fact is exacerbated by informational asymmetries. So you on the outside don't really know exactly what the banks are investing in. The banks conceptually provide a useful function of delegated monitoring. So you have a household sector with excess funds that need to be invested. They don't know anything about the companies that may want to borrow from them. And so the bank acts as an intermediary between a household sector with excess funds and a corporate sector in need of funds. And that maturity and credit transformation is a valuable step in our economy. However, it does lead to fragility within the financial sector. Now, given the banks act as delegated monitors, there is sometimes a need for someone to monitor the monitors. And again, if you think about the need for supervision, we don't need people to monitor, let's say, the bowling alley industry. Right? If there's too many bowling alleys or not enough bowling alleys, the market will shut them down or introduce them. There's no externalities there. Bowlers will get the chance to bowl if there's enough demand to create bowling alleys. But the banks are different. Right? Banks, there is an externality to banks in capital formation and deployment for real variables like GDP. They have a large effect, not an incremental effect on the economy as a whole. And therefore, we put resources to monitor to make sure that those banks are acting responsibly in that role of intermediation. And there are agency problems as well, which also makes also introduces a need for potential need for regulation. Banks have an incentive to take a risk in excess of socially optimal risk taking. And now that's true for all leveraged companies, the whole literature, academic literature on risk-taking by troubled firms, the go-for-broke strategies as firms enter difficulties. But the problems are particularly acute for financial firms due to the high leverage that's inherent in their business model. And in addition, as we introduce public sector mechanisms like depository insurance, those agency problems have become even greater because the depositors then will no longer monitor the bank for the financial health because they are insured. So these market failures create this microprudential focus on the safety and soundness of individual bank holding companies. So broadly defined, the safety net to protect depositors. There's deposit insurance, so currently the FDIC provides that in the United States. There's discount window facilities to assist a bank who has temporary liquidity problems from failing due to the fragility of their business model. And there's also introduced sometimes special liquidity facilities to more focus on individual problems within individual sectors. In addition to the safety net, there's required disclosures that bank supervisors impose to ensure that creditors have sufficient information to make informed decisions about companies. And it's a supervisory examination process sets minimums on, let's say, capital and liquidity, and they test for appropriate controls within the bank or bank holding company. But once you introduce things like depository insurance and discount window access and other facilities, those steps which are made to solve some of the market failures introduce other unintended consequences. So depository insurance, for example, may lead to lower monitoring by depositors and may increase the excessive risk-taking by the firms. You could think about the S&L crisis in the United States in the 80s as an example of that, where people who were able to buy $100,000 CDs from S&Ls, they just really cared whether the CD was guaranteed. They didn't really care about the name behind it because their exposure was to the FSLIC, not to the individual name of the firm. And that really distorts the capital allocation and liquidity allocation within the economy when the providers of capital don't care about the creditworthiness of the institution who are seeking funds. So these type of distortions within the economy needs for leads to not only things like safety nets, things like discount window access and depository insurance, but a whole set of responses from the official sector for regulation and supervision, capital requirements, liquidity standards, limits on concentration risk, and examinations of the risk controls within place, the governance and incentive structures within the bank holding companies. But these are all microprudential considerations, and they've been in place in the United States for quite some time. As we move from the microprudential, we think about risk focusing our supervision, evaluate the bank holding company's financial condition, its resilience, and understand the vulnerabilities through the assessment of the inherent risk of the bank's business model, of its financing sources, of its investment strategies, and the like, and look at the effectiveness of those internal controls. The supervisory process currently has a variety of tools. We do, for the largest systemically important banks, have continuous monitoring of their financial condition. So there's regulatory data that's gathered and analyzed. There's market signals from stock prices, bond prices, CDS prices, and the like. And we get the internal data from the individual institutions and compile that for the cross-institutional assessments. In addition to a lot of data that we get and analyze, we do targeted exams. So that might take the form of an exam where specific concerns have been identified over an emerging risk or a business practice. There's something called discovery reviews, and those are things that we know that we don't know. So a bank might go into a new business, they might enter in a new geography or a new business practice, and we'll go in and just without any prior knowledge of a problem, we'll just go in to see exactly what the bank is doing and how they're managing the growth into that new area of business. And we do horizontal industry reviews. So sometimes we'll see a problem at one particular institution and wonder, well, maybe the similar problems are evolving in other institutions. And we'll create a common scope and go in and look at 5 or 10 institutions simultaneously that'll help us devise best practices and help us devise guidance for the industry if guidance is needed. And then we assess the bank holding company processes. There's the traditional auditing type of examinations where we look at governance and risk controls. We look at senior management oversight, internal audit, risk reporting, and the like. So the results of those supervisory processes frequently revolve around feedback to the bank holding companies. One of the most important feedback is an annual formal comprehensive assessment of the inherent risk and the risk controls, and they're rated on a 5-point scale. It might be CAMEL's rating, which is capital asset quality, management earnings, liquidity, and sensitivity. Or it might be the RFI framework that we, with the Fed, have in risk management, financial worthiness, and the impact of the depository on the bank holding company. And or it might be periodic examination letters when we go in and do a targeted review on a particular area, or a discovery review, or horizontal. Frequently, it'll be formal letters sent with expectations about changes that we supervisors expect or demand in terms of matters requiring attention or matters requiring immediate attention from the institution. In addition to these formal, periodic, regular sort of business as usual events, there's also an escalating series of enforcement actions that the Fed can and does take. And those are usually for pretty egregious shortcomings that require really immediate attention by the bank holding company. And it can form a whole range of written agreements, memorandum of understanding, cease and desist orders, and even more stringent requirements. So when we take these sort of traditional bank-by-bank analyses in the microprudential, and we bring that to the macroprudential, we really are thinking about the institutions, and when there are systemic events, when events affect multiple institutions, or as a cascade from institution to institution, and there are negative externalities to the economy, we really recognize the banking sector as an important element of the health of the economy as a whole. And these systemic events that harm an individual or set of banks or financial institutions create this negative byproduct that hurts the efficiency of the banks to help deploy the economy's resources effectively. And those linkages are often linked to leverage, maturity transformation, common exposures across the bank holding companies, and interconnectedness across the institution. Some of the manifestations of these problems occur when there's fire sale effects. So a particular institution may have low capital. A shock to market prices will force them to sell some of their assets, and usually they try to sell their high risk-weighted assets. That sale in itself will lead to a deterioration in the asset prices, and that itself may affect someone who started out looking stronger. And so there's a cycle about the selling out of institutional or bank holding company holdings of risky assets. And you very well could see just a market failure. There are no buyers for particular assets. And that's really what we saw in 2008, where firms were challenged to mark their books to market because of, let's say, private label RMBS, or this multi-sector CDO market or other markets. There just were no buyers for it. And so they had to rely on alternate ways of trying to view the intrinsic value. But that makes the valuation process much more difficult to assess from an outsider's point of view. And again, there's a cycle of people being worried about the health of other institutions that originally weren't involved in the problem assets. The second point is credit provision to credit-worthy borrowers are negatively affected. So if banks are near their minimum capital ratios and there's a shock to the economy and they fall below minimum standards required by regulators and supervisors, they then pull back in new lending until they're able to build back up their capital ratios, and that has a negative impact on the economy as worthy projects and worthy firms are not funded by the banking sector. And all of this leads to this feedback effect where the anomalies originally impacted to one firm or a set of firms spiral and negatively impact others. So even greater intervention is required by the public sector. Now, in general, the implications for industries with these sizable negative externalities include the insight that laissez-faire level of systemic risk is not socially efficient. The banks have a negative externality. They don't internalize that cost that others bear with their failure. So this leads to more intrusive policies from the external sector to raise liquidity standards, raise capital standards, raise expectations on governance and so forth, so that these banks will then internalize what is a negative externality. So this justifies a safety net to minimize the effect of the bank failures. Now, this has a negative result sometimes of creating the too big to fail perception and its attendant distortions. One thing that comes out of this is the optimal level of systemic risk is likely not zero. If it were, you might think about a solution like nationalizing the banks. You could create such capital requirements that are so great that banks leave the banking sector or there's no entrance into the banking sector, and that's likely not the best solution. So it really is a balance between allowing the private sector banks to engage in the type of transformations on credit and liquidity and maturity transformations that make them a valuable part of the economy, but at the same time not let them take advantage of the safety net created and necessitated by that fragile business model. So the macroprudential policy guards against the likelihood of a systemic event and guards against the effects of a systemic event if it were to occur, but likely we can't prevent a systemic event from occurring. So one of the discussions really over the last couple of years when we talk about this distinction between macroprudential and microprudential is that the macroprudential really isn't merely the sum of effective microprudential supervision. It really is more. The objectives differ, the processes differ, and the outcomes differ across these two regimes. So this is just a chart from compiled from different places in academics and in the central bank world. So the ultimate objective for microprudential supervision for an individual firm really has to do with protecting that depositor and protecting the investors. But when you think about from a macroprudential, again, we don't have an inherent feeling of trying to protect the banks or the banking sector. We care about protecting the banking sector because of these externalities. We really care about the real economy and its stability and its growth. And so we supervise banks to, this is just one example, avoid GDP loss. We care about employment and growth and other things on the macro scale. And so I won't go through each of these, but the view of the macroeconomy, endogenous versus exogenous. I'll just give an example here. When you think about an individual bank lending into the subprime market, they think they have a very small impact on the prices of housing, right? The price of housing is exogenous to them, and they're just lending to somebody to buy a new house. But when you think about the banking sector as a whole, their credit standards and underwriting standards to potential home buyers could have a very material impact on the price of housing. So that would be a very different way of viewing banks. And so when we look at banks, we do have the Microprudential supervision standards about what makes a good loan from an individual bank to an individual mortgage holder. But we also have to take a step back and think about what's happening in the industry as a whole and what's happening to the effect on housing price stock and what negative impact that could have if it's feeding into a housing price bubble. And then the direction of the effect is also something to think about. On the micro side, we think about the impact from the macroeconomy on an individual bank, and we want to protect the banks from problems in a business cycle. But from a macroprudential point of view, we think about the impact on the macroeconomy by and financial system on the actions of banks, and we want to protect the business cycle from problems in individual banks. So it really is macroprudential and microprudential are not really getting at the same issues or same objectives or same outcomes. They really are a different way of looking at how we supervise the banks and banking sector. So now I'm going to turn to from the conceptual to some of the recent initiatives in response to the recent banking and financial problems. So there's been some pretty fundamental changes in the supervisory and regulatory processes. As I mentioned, the capital plans rule, Basel III, and the Dodd-Frank Act, and each of these have microprudential and macroprudential aspects to them. So the capital plans rule, which is really a key U.S. regulatory response to the crisis, requires from all banks with at least $50 billion worth of assets to provide a forward-looking capital plan as part of an assessment of the proposed capital distributions. So here, before a bank can pay dividends or buy back shares or make certain purchases, they need to provide a capital plan that's credible and approved by the supervisors. The broadest assessment of capital planning adequacy for the largest bank holding companies, again, those with more than $50 billion worth of assets, is really a critical enhancement to both the macroprudential and microprudential supervision. So it really does look at individual banks and their plans and what they plan to do, but it also allows us as supervisors to array all the banks simultaneously, to take a look at vulnerabilities within banks simultaneously to changes in the macroeconomy. And that's closely linked with what's called CCAR, or Comprehensive Capital Analysis and Review Process, and that really holds for the top 18 bank holding companies. So it's a subset of the capital plans rule population. So when we take a look at that, we look at a lot of the aspects of the bank holding companies' processes related to how they manage their own capital. So we look at the entire capital planning processes. We look at their policies and their plan distributions. We see how they risk measure their capital needs to shocks to the economy and how they manage that, how they plan to respond to different scenarios. And for those banks that will be covered by Basel III, we'll look at their plans under the current regulatory regime as well as the coming Basel III requirements. And whether the bank is in the CCAR subset or not, we look at their stress testing capabilities to see exactly how onerous are the stresses they put upon themselves, they put their process through. We take a look at how comprehensive their risk capture is and how the idiosyncrasies of particular banks' positions are managed. So you might have a trading position, for example, and you run it through a shock where equity prices fall 50%, and that might seem very stressful. But if the bank is short equities, that's not stressful at all. In fact, it's accretive to their capital. So we take a look at to ensure that the scenarios capture idiosyncratic risks. So that was the U.S. regulatory response. More broadly, the key international regulatory community responded with Basel III, and it has both capital and liquidity standards for internationally active banks. The U.S. hasn't finalized its liquidity requirements yet, but is in the process of doing that. So we have a new minimum common equity standard of 4.5% of risk-weighted assets as opposed to the old standard of 3%. There's a capital conservation buffer, so if there's additional capital you need to hold if you want to pay out the dividends or make share repurchases. There's a countercyclical buffer of 2.5% or up to 2.5% based on national circumstances. That has not been imposed yet in the United States, but some countries, including Switzerland, have already imposed that. There's been changes to the risk weights to better reflect risks, stress estimates, and interconnectedness across banks. There's additional loss-absorbing capacity for systemically important banks. So there's something affectionately called the SIFI surcharge, and that's for up to 2.5% of risk-weighted assets is an additional buffer required for systemically important financial institutions, or SIFIs. Now, in the U.S., the FSOC, Financial Stability Oversight Council, hasn't yet named which banks are going to be considered in the SIFI population. So that's another change that hasn't been implemented yet in the United States. But this, in general, in Basel III, remember, this is the international accord. This is not the U.S. specific. But these are the ones we're going to adopt as appropriate in the United States. But the expectation internationally is this is going to be phased in over a pretty long period of time to be finalized in 2019. So a lot of these haven't been imposed yet in the United States, but it's not like we're behind other countries. There is the expectation that it's going to be a while before these are fully in place. Now, each of these Basel III standards has both the micro and macroprudential aspects to it. So there are stronger capital and liquidity requirements, and that's the micro, really microprudential in nature. But there's changes to risk weights to better reflect interconnectedness across the financial institutions. This counter-cyclical buffer is meant to really restrain a boom. So if there's a credit boom within your economy, and that's going to happen outside the banking sector, but the idea is that you would the supervisors during those phases would require banks to hold a larger amount of capital during those times. And there's a greater focus on the SIFIs that generate externalities. And just 1 minute on Dodd-Frank, which is the U.S. congressional response to the crisis. There's a broad range of initiatives. A lot of them focus around financial stability. There's an orderly liquidation authority to wind down SIFIs, whether banks or non-banks. The Volcker rule is implemented to limit proprietary trading within the bank holding company. OTC derivatives were formed to encourage banks to settle OTC derivatives through a central counterparty or a clearinghouse, and enhance the capital and liquidity standards as well. To focus on financial stability and capital standards for BHCs, support the macroprudential supervisory perspective, and Dodd-Frank broadens their focus of traditional micro to include financial stability concerns. There's enhanced supervision of prudential standards for banks and non-banks if they're deemed to be systemically important. The Federal Reserve has expanded exam authorities, and there's changes in the mergers and acquisition applications so that there's a consideration for two large firms will they become systemically important that will discourage the approval of that type of merger. So these conclusions are derived from the presentation. So the financial crisis really highlighted this need for effective microprudential and macroprudential supervision, where bank holding companies were deemed to be need to be more resilient, better managed, and less complex. The fundamental changes that we've seen so far has been a good start, but as we know, as I tried to highlight, there's a lot of work yet to be done to finalize the changes. And we'll continue to evolve as supervisors and regulators as the bank holding companies evolve. There may be unintended consequences from the reforms that are in place, and we'll need to respond to that. And how the shadow banking sector will evolve is also unknown at this point. So we'll have to keep an eye on those developments. That's it.
Thank you.
Okay.
Jim?